If you want to build lasting wealth and achieve long-term economic success, the first thing you must understand is how the world actually works. The economy, the markets, and even human behavior all operate in cycles. These cycles are not random. They follow patterns that repeat over time, shaped by cause, and affect relationships that are as consistent as the laws of physics. Most people fail in investing because they treat the markets as unpredictable, emotional systems. But once you start studying how these cause and effect mechanics operate, you realize that the world makes far more sense than it appears on the surface. The economy is essentially a machine. It's made up of millions of transactions that repeat every day. People buying, selling, borrowing, lending, working, and consuming. When you aggregate all these transactions, you get economic growth, inflation, debt cycles, and market prices. Every decision made by an individual or institution adds a small piece to this vast machine. And once you learn how the machine works, you can start to anticipate its movements rather than being surprised by them. Let's start with one of the most fundamental forces, credit and debt. When you borrow money, you're essentially bringing future spending into the present. That creates short-term growth, but at the cost of future repayment. When borrowing and lending expand across an economy, spending increases, businesses grow, asset prices rise, and optimism builds. But as debt accumulates, so does the burden of repayment. Eventually, borrowers must cut back on spending to service their debts, and that slowdown triggers the next phase of the cycle. This is why economies move in short-term debt cycles, typically lasting 5 to 10 years, and long-term debt cycles that unfold over decades. Each boom creates the seeds of its next bust. Each bust resets the system and allows for a new expansion. When you start to recognize these patterns, you no longer fear recessions or market corrections. You see them as natural parts of the economic rhythm, much like the changing seasons. Most people are reactive. When markets rise, they become greedy. When markets fall, they become fearful. They let emotions dictate decisions. But successful investors, those who understand how the economic machine works, think differently. They observe, analyze, and prepare. They know that booms and busts are not emotional events. They're mechanical outcomes of debt, productivity, and policy. Now, consider productivity growth, another key driver of long-term economic success. Unlike debt, which brings temporary boosts, productivity creates real wealth. When people learn, innovate, and create more output per hour, societies grow richer. The countries that prioritize education, technological innovation, and efficient systems always outperform those that rely solely on credit expansion. That's why understanding the difference between real productivity and artificial growth is crucial. A skilled investor always asks, is this growth driven by productivity or by debt? Because one is sustainable, the other is temporary. Many nations, companies, and individuals make the mistake of confusing the two. They celebrate booms without realizing they're built on leverage. When the debt comes due, those illusions collapse. To truly manage wealth effectively, you must study not just financial numbers, but human behavior, because people drive markets. Markets are reflections of collective psychology. When fear spreads, prices fall faster than logic can explain. When greed dominates, prices rise higher than reality justifies. Human nature hasn't changed for thousands of years. The same emotions that drove market bubbles in the 1600s drive them today. The same fear that caused panics in the Great Depression causes sell-offs in modern stock markets. The difference between successful and unsuccessful investors lies in how well they manage these emotional forces. In my experience, one of the most valuable skills an investor can develop is objectivity, the ability to see reality without distortion from emotions or bias. You must train your mind to step back and look at the data as it is, not as you wish it to be. When the facts change, you must be willing to change your conclusions. The market doesn't care about your opinions, it only responds to truth. To cultivate objectivity, I rely on what I call principle-based decision-making. Instead of reacting emotionally to every market move, I follow timeless principles derived from studying history. I've analyzed decades, centuries of economic data to identify recurring patterns. I treat every new situation not as something unprecedented, but as another example of a pattern I've already studied. This perspective provides clarity and calm even in turbulent times. For example, when central banks print money aggressively to fight downturns, inflation often follows later. When interest rates remain too low for too long, asset bubbles form. When debts grow faster than incomes, a correction becomes inevitable. These are not opinions. They're observable cause and affect relationships. Understanding them allows you to anticipate events and position yourself accordingly. One of the biggest misconceptions people have is that the economy is too complex to understand. It isn't. It's just made up of simple components interacting on a large scale. If you break it down, you can see how everything connects. When credit expands, spending increases. When spending increases, incomes rise. When incomes rise, creditworthiness improves, which fuels more lending, and the cycle reinforces itself until it reaches its limit. Then, when debt levels become too high, the cycle reverses. Borrowers cut spending, incomes fall, and defaults rise. The same feedback loops that create prosperity also create recessions. This is why it's so important to see the big picture. Many investors focus only on short-term data, daily stock prices, news headlines, or quarterly reports. But real success comes from understanding long-term trends and positioning yourself accordingly. You must zoom out and observe the overarching cycles shaping the world. If you study history, you'll see that the same economic forces repeat: debt crises, monetary expansions, inflation, deflation, bubbles, crashes, and recoveries. These have occurred countless times across different centuries and countries. What changes are the details. What remains constant are the principles. So instead of being surprised when a crisis happens, you should expect it. You should know where we are in the cycle and prepare accordingly. That's the foundation of wealth and risk management. Understanding the timeless patterns of reality. The world rewards those who think independently and base their decisions on evidence rather than emotion. When everyone else is chasing trends, the wise investor studies history. When everyone else is panicking, the wise investor sees opportunity. In my own life, I learned these lessons through painful mistakes. I once believed I understood the markets perfectly, only to lose almost everything in a wrong bet. That pain forced me to reflect deeply on what I didn't know. It taught me humility. From that point forward, I realized that success in investing isn't about being right. It's about continuously learning how to be less wrong. So, if there's one principle I would leave you with, it's this: reality is your greatest teacher. Study it, respect it, and align your decisions with it. The economy doesn't care about your opinions or your emotions. It only responds to the universal laws of cause and effect. The more accurately you see reality, the more effectively you can navigate it. When you truly understand how the economic machine works, how money, credit, debt, productivity, and psychology interact, you no longer feel lost in the chaos. You begin to see patterns where others see randomness. You begin to see opportunities where others see danger. And most importantly, you gain the confidence to make sound, principled decisions that lead to long-term wealth, stability, and success. That's where real investing wisdom begins, with understanding not prediction with principles, not opinions with clarity, not emotion. If there is one timeless truth about building wealth and preserving it, it is that balance is the foundation of stability. Nature works through balance. Every system that survives does so by managing opposing forces in harmony. The same principle applies to investing. You cannot control the future, but you can design your portfolio so that no single event, no single decision, and no single mistake can destroy you. That is the essence of diversification and balance. Not just a financial tactic, but a universal principle. In the markets, everyone is looking for the next big win. They chase what's rising, they fear what's falling, and they make concentrated bets on what they believe will outperform. But reality is unpredictable. Even the smartest analysts, the most sophisticated models, and the most powerful institutions are often wrong. The future always holds surprises. So instead of trying to predict, the wiser approach is to prepare, to construct an all-weather portfolio that performs reasonably well across a wide range of possible futures. When I studied markets over decades, I learned something remarkable. Assets behave differently under different economic environments. Sometimes inflation rises, sometimes it falls. Sometimes growth accelerates, sometimes it slows. Sometimes interest rates are high, sometimes they are low. No single asset performs well in all those conditions. But by combining assets that thrive in opposite environments, you can create a portfolio that's resilient no matter what happens. Think of it like a biological ecosystem. A forest doesn't depend on one species to survive. It's the diversity of trees, plants, and animals that allows it to thrive through storms, droughts, and seasons. In the same way, your portfolio must have that diversity of species. Stocks, bonds, commodities, real estate, and cash all respond differently to the same economic forces. When one suffers, another prospers. Together, they create stability. This idea led me to what I call a holy grail of investing, finding a set of investments that are not correlated with one another, but still produce good returns. If you can hold a mix of 10, 15 good, uncorrelated assets, you can reduce your risk by 80% without reducing your expected return. That's an extraordinary result. It shows that diversification isn't about spreading yourself thin. It's about designing a structure where the whole is stronger than the sum of its parts. But diversification is often misunderstood. Many investors believe that holding a variety of stocks is enough. It isn't if all your assets depend on the same economic driver. For example, rising growth or falling interest rates, then they're not truly diversified. Real diversification means owning assets that respond differently to different conditions. It means including things that might feel uncomfortable, assets that don't always move with the crowd, but protect you when the crowd is wrong. For instance, during periods of strong economic growth and low inflation, equities tend to perform well. But when inflation surges or growth slows, equities struggle, while assets like inflation-linked bonds, commodities, or gold may do better. By holding all of these in balance, you reduce the chance that any single event wipes out your wealth. You shift from being a speculator to being an architect, designing a system built on principles rather than predictions. And this principle of balance goes beyond investing. It reflects how nature itself operates. Every force in the universe has an opposing force: expansion and contraction, creation and destruction, growth and decay. Systems that ignore balance eventually collapse. A tree that grows too tall without deep enough roots falls in the storm. A company that expands too aggressively without financial discipline breaks under debt. An investor who bets too heavily on one outcome may look brilliant for a while until the cycle turns. True wealth management, therefore, is less about making bold predictions and more about managing probabilities. It's about acknowledging what you don't know and designing your strategy accordingly. The most dangerous words in investing are, "I'm sure," because no one can ever be sure. Even the most seasoned investors face uncertainty every day. The only reliable protection against uncertainty is diversification. Diversification also protects against human weaknesses. Every investor, no matter how disciplined, is influenced by emotions. We all feel fear when markets fall and greed when they rise. But a well-balanced portfolio prevents emotions from dictating decisions. When one part of your portfolio is losing, another part is likely gaining, which keeps your overall balance steady. That psychological stability is as valuable as financial stability. It allows you to stick to your plan instead of panicking or chasing trends. I've often said that successful investing is like playing poker with the best players in the world. You can't control the cards you're dealt, but you can control how you manage your chips. Concentrating all your chips on one hand is reckless. Spreading them across the table, based on probabilities, is strategic. Diversification is that strategy. It's the disciplined way of surviving when luck turns against you. In my career, I've seen many investors destroyed not by lack of intelligence, but by lack of balance. They were brilliant, but they were overconfident. They built portfolios that performed spectacularly under one condition and catastrophically under another. They didn't respect the power of the unknown. In contrast, the most enduring investors, those who survive multiple recessions, bubbles, and crashes, are the ones who accept uncertainty and prepare for it. Balance also applies to risk. Most people think of returns first and risk second. I think the opposite. If you manage your risks well, the returns will take care of themselves. You must know your vulnerabilities, what could hurt you, and ensure that no single event can cause intolerable loss. That's why every portfolio I build starts with a simple question. What if I'm wrong? Because being wrong is inevitable. What matters is surviving it. In practical terms, that means designing portfolios that hold both offensive and defensive assets. Offensive assets, like equities and private investments, capture upside in good times. Defensive assets, like bonds, gold, protect you, or cash in bad times. The balance between them changes depending on your goals and risk tolerance. But the principle never changes, never depend on any one source of return. When you think about it, diversification is humility in action. It's an admission that the future is unknowable. It's a recognition that your beliefs, no matter how strong, might be wrong. And that humility is the foundation of wisdom. Every great investor I've studied shares that trait. They respect uncertainty. They don't try to fight it, they design around it. The beauty of diversification is that it turns volatility from an enemy into an ally. When markets swing wildly, your balanced portfolio adjusts automatically. The assets that rise offset those that fall, creating smoother, more predictable progress. Over time, that consistency compounds. Wealth grows quietly, protected by balance, guided by discipline. And there's a deeper truth here. Balance creates freedom. When you know your financial foundation is stable, you can make decisions from a place of calm rather than fear. You can think long-term instead of reacting short-term. You can take opportunities when others panic because you've prepared for the downside. That's the real power of diversification. It gives you the emotional and financial space to act rationally in an irrational world. So whether you're managing $1 billion fund or your personal savings, remember this success isn't about making one great bet. It's about designing a resilient system that works across time and circumstances. You can't eliminate risk, but you can spread it, shape it, and balance it. When you do, you align yourself with the natural order of the world. The same order that allows forests to thrive, oceans to stabilize, and civilizations to endure. That's why diversification and balance are not just strategies, they are principles of life. They reflect the wisdom of nature. That harmony, not dominance, creates endurance. The investor who understands that doesn't just survive market storms, he thrives through them, quietly compounding wealth while others are tossed by the waves. That's the power of balance, the quiet, steady force that turns uncertainty into opportunity and builds the kind of wealth that lasts for generations. Every meaningful success I've ever experienced has come from a painful mistake. Pain is not something to avoid, it's something to study. Most people try to escape pain, but those who grow the fastest are the ones who run toward it with curiosity. The simple formula that has guided my entire life is this: pain plus reflection progress. It sounds simple, but it's one of the most profound truths you can apply to investing, business, and personal growth. Pain is nature's feedback mechanism. It's the signal that something isn't working as intended. When you touch a hot stove, pain tells you to pull your hand away. When you make a bad investment, the loss tells you that your assumptions were wrong. Pain points directly to your weaknesses, your blind spots, your errors in judgment, your emotional biases. If you can resist the urge to look away and instead study it deeply, that pain becomes a teacher far more powerful than any book or lecture. Most people don't progress because they don't reflect. They experience pain and immediately react. They blame the market, the economy, bad luck, or someone else. But in doing so, they lose the lesson that the pain was trying to teach. The best investors and the most successful people in any field do the opposite. They pause. They analyze. They ask, why did this happen? What was my role in it? What did I miss? That reflection transforms pain into wisdom. In my early years as an investor, I thought being right was the goal. I believed that success came from making smart predictions and proving my intelligence. Then I made a series of painful mistakes, ones that nearly wiped me out financially. I lost confidence, money, and reputation. But looking back, those were the most valuable experiences of my life because they forced me to confront my weaknesses head on. Without that pain, I would have kept repeating the same errors, blind to my flaws. When I began to reflect deeply, I realized something fundamental. My confidence had been misplaced. I was overestimating what I knew and underestimating what I didn't. That realization reshaped my entire philosophy. I started to treat mistakes not as failures, but as data, valuable information about how reality works and how my understanding of it could improve. Pain illuminates reality. It strips away illusions. When markets crash, when investments fail, when your thesis breaks, you come face to face with the truth. It's uncomfortable, but it's also clarifying. You learn how the world actually operates, not how you wish it would. Every setback contains a blueprint for future success if you're humble enough to see it. The reflection part of the formula is where transformation happens. Reflection means stepping back and analyzing the cause and effect relationships behind your pain. It means asking hard questions without ego or defensiveness. Why did you miss that signal? What emotional trig